Brilliant. The time is 12 o'clock. So good afternoon, everyone, and thank you for joining the final session of our long-term opportunities for income and growth investors. Delighted to be here with Dean Orrico, who is the President and CEO of Middlefield. Obviously, I'll hand over to Dean very shortly to run through the investment case for Middlefield Canadian Income, the trust that Middlefield run. But just in the meantime, while I can see a few attendees still joining, I'll run through a little bit of housekeeping. Most importantly, attendees will be on mute for the duration, but if you have any questions, please use the Q&A function in the bottom right-hand corner of WebEx. Dean will speak for about 20-25 minutes, possibly half an hour, and we'll leave around about 15 minutes at the end for a Q&A. So feel free to get those questions in as Dean is talking. In terms of the trust itself, clearly it's probably a geography that you've perhaps not looked at too closely over the past years, but one that we think is perhaps better placed than most to take advantage of some of the opportunities that are thrown up in the current macro environment. You know, it's been a challenging time for investors, and we think it's a very good time to be looking at Canada. Moreover, the trust itself is trading on around about a 15 discount at the moment, which feels wide and quite a nice opportunity. And at current levels is yielding well over 4%, which is great. I think that's about it from me, and clearly you're not here to listen to me. So without further ado, I will hand over to Dean to run you through the slides. Thank you very much.
Thanks, Hugo, and thank you everybody for joining us today. As Hugo mentioned, we've got a very unique story to tell, unique for UK investors, because as far as we're aware, the opportunity in the investment trust space to gain exposure to Canada in a fund which offers a high and sustainable dividend, we think is, as I say, very unique. And that's really what Middlefield Canadian Income Trust is all about. And I have some prepared slides here in front of you. And I think there are a number of reasons why UK investors should really be considering Canada as an opportunity to diversify their portfolio. And I've got a number of points on this slide which I think highlight this. But prior to digging into that, I really want to maybe provide some perspective in that if we will look back over the last 30 years or so, we've gone through various economic cycles, and I believe that over the past 12 months, we've hit an inflection point, which I think will begin another economic cycle. So just taking it back, when China entered the World Trade Organization, that really did kick off a period where commodities came into favor. We really embarked upon a commodity super cycle, and that lasted for roughly 10 years. And subsequent to that, when we were getting very concerned about deflation as opposed to today's problem being inflation, that really led central bankers to embark upon a period of zero or very, very low interest rates. And during that period, anything that was very growth oriented, like technology, really became the place to be if you wanted to generate economic returns in the equity market. And as I say, I think over the past 12 months, we've hit another inflection point, which has really ended that period of low to zero interest rates. Because we're now in an era where we've got the early stages of deglobalization, which I think is inherently inflationary. We've got issues with supply chains, which clearly have become inflationary. And we believe this current period of inflation is going to be lasting for a longer period, which really means that interest rates, in an effort to combat inflation, will stay higher for longer. So that period of high duration equities that benefit from very low to zero interest rates, we think is in the rearview mirror. So we're back into a period where we think you're, as investors, looking to find areas where you can gain a hedge against inflation. And in our view, equities are the best place to do that. And specifically in areas which are more value or cyclically oriented and hence pay higher levels of income to investors, we think will be the way forward. And when you think about Canada, Canada is an area that is a sector where you really don't have technology as significant as it is, say, in the US market, but you do have areas which are more cyclically oriented, more value oriented, and areas which pay very high levels of income. So I think the market's basically coming back to what Canada offers and really what we're known for. And some of the points that are on this screen, I think, really highlight that. We are a net exporter of oil, gas, and electricity. The Canadian workforce is highly skilled and very educated, but like many other countries, we actually have a shortage of labor, and that really does drive the Canadian government to continue to encourage high levels of immigration into this country. Today, we're bringing in about 400,000 new immigrants every year. That's on a population of about 38, 39 million people. So in essence, we're adding more than 1% of our population every year in the form of new immigration. That's virtually unheard of in the G7. And the other, I think, important thing to highlight here with respect to Canada's immigration is that we've got a fairly sophisticated points-based immigration system. So our immigrants basically become pre-qualified, and because we have a lack of labor in this country, we're trying to identify immigrants who can immediately contribute to the labor force, who in essence are not a drag on the economy, but are contributing to economic activity from the day they arrive here. And as a result, somewhere between 60 and 65% of Canadian immigration come in under what we call the economic class. They're typically between the ages of 25 and 54, and as I say, are more of a fit for some of the labor shortages that we've got in this country. And that, in our view, is among the most sophisticated and robust immigration systems, basically in the G7. We've also got a thriving tech industry in Canada. When you think about the newest companies coming into the Canadian market, they typically are the largest tech businesses in the US, whether it's Microsoft, Amazon, Google. Places like Toronto, Vancouver, Montreal, among Canada's biggest cities, have some very significant universities producing a real tech hub in those areas. So as a result, Toronto, where I live, where I'm speaking to you from today, is the third largest tech hub in North America, third to Silicon Valley, the greater New York market, and then comes Toronto. So as a result, our economy has become quite diversified over the past 10 years as well. And as a result of that diversification, the market capitalization of the Toronto Stock Exchange, which is the main exchange in Canada, is actually larger than market capitalization of the London Stock Exchange. So that actually surprises quite a few people, but Canada is no longer a smaller player among developed economies. We are a major stock market, which we believe warrants attention from investors looking to get international diversification. And before I leave this slide, I just wanted to highlight how our market is valued today. And when you compare it to our large neighbor to the south, the Canadian market today continues to trade at a significant discount to the US market, even with the pullback that you've seen in US equities on a year-to-date basis. Just to give you some raw numbers, the Toronto Stock Exchange today trades at about 12 times next 12 months earnings. So it's a PE multiple of about 12 times. And that's actually very low by historical standards for the Canadian market. And as I say, quite a bit lower than the US market, which trades today somewhere around 16 to 16 and a half times the next 12 months earnings. And one of the major reasons why the US market is trading at a higher multiple is because of technology. Even though tech sector is down on a year-to-date basis, it still trades at a premium to the average company in the S&P 500. So let's assume for a second that you eliminate tech, which represents somewhere around 20-25% of the US market, which has got a higher multiple than the average. The average goes down to only about 15 times from 16 to 16 and a half. So on an X technology basis, Canada still trades at about 3 multiple points lower than the US market. So again, I think it's just evidence of the relative value that you're getting in the Canadian market. So today, basically, when you look at various economic factors, Canada actually is positioned quite nicely versus both the US and the UK, whether that's real gross domestic product, which really measures the growth of our economies, household consumption, labor force participation, which is a major factor right now because there is a shortage of labor. Part of the issue in places like the US is that you've got people who have basically dropped out of the workforce over the past 2 to 3 years. And this is typically that cohort between the ages of 55 and over who've decided, maybe because of the pandemic and how things are so challenging, have decided to basically go into retirement. And we don't necessarily have that issue in the Canadian market because our participation rate, as you can see on this slide, is about 5 percentage points higher than what you're seeing in the US market. And as a result, our trade surplus is in the positive territory, far better than what you're seeing in both the US and the UK markets. And at the bottom of this slide, you can see this point on population growth, where Canada, amongst other G7 countries, has grown their population over the last 5 years by about 5%. And you can see in places like Japan and Italy, they've actually seen a contraction in their overall population. These are very important issues, especially as it relates to inflation, because we're not seeing in our country the type of wage price pressures, i.e. increases, that you're seeing in a number of other G7 economies. So what we like to say as a result of this backdrop is that Canada generally is a good hedge against inflation. As I say, we're a net exporter of oil, natural gas, which has become a very important fuel, and electricity. Our oil and gas producers, as well as our pipelines, are certainly benefiting from higher commodity prices. And as far as natural gas goes, we know the difficulties that are being experienced specifically in Europe as well as the UK with much higher natural gas prices. Imported natural gas prices, i.e. liquefied natural gas prices, which is becoming an increasing source of natural gas for Europe as a result of cutting off gas from Russia, are somewhere between 4 and 5 times higher than the natural gas prices that we're paying in Canada or the US. So the energy security issue, and specifically natural gas, which we think is becoming a very important bridge fuel to a cleaner energy future, we think is going to really distinguish a major economic issue between continental Europe in particular, as well as the UK and North America, because we have this abundance of natural gas here. And while we're moving to a cleaner energy future, we think that's going to play out over decades. And as a result, access to lower priced and secure sources of natural gas is becoming increasingly important. We're also a major producer and exporter of other commodities, whether that's potash, which is a major fertilizer, aluminum, cobalt, gold, as well as uranium, which again, uranium is the fuel for nuclear power generation. And we think that's going to be an increasing focus for electrical power generation as we move to a cleaner energy future over the next 2 to 3 decades. So bottom line is, we think Canada is well positioned in light of some of the challenges that are facing the global economy. And in respect of inflation, and I touched on this point on the last slide, but here's a good graphic which helps explain it, that going back to the early parts of this year, when you look at inflation in Canada versus the US versus the UK, you can see we've been consistently lower, and inflation in this country has already rolled over. And that's the reason why the Bank of Canada a few weeks ago surprised everybody when we thought they were going to increase the overnight rate by 75 basis points and went by a lower 50 basis points. And since then, Tiff Macklem, the governor of our Bank of Canada, has come out and saying that things are starting to get under control. we're seeing the light at the end of the tunnel in terms of seeing lower interest rates going forward versus higher interest rates. So in fact, at the next Bank of Canada meeting in December, we may in fact see a 25 basis point increase, whereas I think the US is looking at least 50, if not 75 basis points during that period. And I think that bodes well for equities in this market. This slide gives you a sense for how our portfolio is positioned. So for the next few slides, I'm really going to talk about how Middlefield Canadian Income Trust is positioned amongst the various equity market groups, and why we're excited about the opportunity to generate strong returns by investing in the Canadian market. So we have the ability in this fund to invest in the US as well, but it will always be Canadian centric. And we can go up to 40% of the portfolio in the US, but as you can see on this slide, we're so much more positive on the outlook for Canada that about 95% of our portfolio currently is invested in Canadian companies, and approximately 4 to 5% is in the US market. So that gives you a sense for how much more constructive we are on Canadian equities versus US equities. We're paying a distribution in this fund equal to 5.1 pence per annum. So that's paid out on a quarterly basis. And that reflects a yield today of about 4.2%. And that dividend today, by virtue of the dividend income that we're earning in our portfolio, is fully covered. So it's important. The way we manage money across Middlefield, including this fund, is we are what we describe as high conviction managers, not high concentration, high conviction. What does that mean? Basically, we own somewhere between 30 and 40 issuers in this portfolio, and each company would have a minimum weighting of 1% of the fund and up to 5% of the portfolio. So we maintain broad diversification by company as well as by sector. And as you can see on this slide, our performance numbers, if you go back to when this fund was launched in 2006, it's generated an annualized return based on our net asset value of about 7.5%, which exceeds our benchmark of about 7%, or the broader Canadian market of about 6.3%. And what's important about that is that a significant portion of that return, at least 50%, is coming by way of this dividend that we're paying, which we say is basically fully covered based on 2022's income, and we think really does represent a valuable way to dampen some of this volatility that you're seeing in equities more broadly by earning a product like this, which pays out high and regular distributions to investors. Just by way of background, as President and CEO of Middlefield, I oversee our investment products, but I'm the lead manager on this fund. And I joined Middlefield back in 1996. So I've been here for a long time. And I've been involved in Middlefield Canadian Income Trust since its launch in 2006. My co-managers here, a fellow by the name of Rob Lozon, and I have Robert Moffat, who's on this slide with me, who's been with me in the UK meeting investors and works closely with me in supporting the management of this portfolio. As far as ESG goes, this has also been a focus for us. Basically, we consider ESG factors in every investment that we make. This is not an ESG fund per se. We do have some ESG funds that we run for Canadian investors, but this particular fund considers ESG factors across the broad spectrum of securities that we own in this portfolio. And a few years ago, we have brought on a head of ESG, a fellow by the name of Steve Ehrlichman, who's one of the foremost governance experts in the Canadian market. And we've really broadened our ESG framework, as well as hired Glass Lewis, who's a well-known international ESG proxy advisor. So this is a part of the market that we take very seriously in considering owning and monitoring the names in this portfolio. So let's dig a little deeper into how the fund is positioned today. Basically, we have a very significant weighting in the financials area. The Canadian banks, in our view, are amongst the strongest, if not the strongest, of any banking sector globally. I'll get into that in a few more minutes. We've got a significant overweight position in Canadian real estate. Real estate today in Canada, or this year in Canada, not unlike the US, not unlike the UK, has really been an underperformer. Our real estate market in Canada is down by about 20%. But the fundamentals in this market, and I'll get into that in a few minutes, we think remain very robust. And the other major areas of exposure will also be the energy area. So when you think about energy producers, as well as our pipelines, we're at about market weight, and we think each of these areas is very important. Across those two sectors, that's about 30% of our portfolio. So when you consider financials, you consider property and energy, that represents about 3/4 of the overall portfolio for this fund. And those are the areas I'm going to be highlighting over the next few minutes. Let's first start with property. As you can see on this slide, our Canadian REITs in Canada trade at about a 20 to 25% discount to their net asset value. And again, that's about as lowest a valuation as we've seen over the last 25 years. And we think this really does represent excellent value. And this was really confirmed earlier this week when one of our industrial property REITs, this is what we call the sheds in the UK, we call them industrial properties here in Canada, was taken over, or was the announced takeover, basically by the Sovereign Wealth Fund of Singapore at a premium of 30% to the trading price on Friday. So on Monday morning, I came into the office, and the company was Summit Industrial REIT. It was announced that it was being taken over at effectively $23.50. On Friday, the previous trading day, the stock was trading about $17.90. And it basically did confirm our view that there is tremendous value in these companies when we have some very smart money like the Singapore-based Sovereign Wealth Fund recognizing this value. In essence, what's happened is our whole REIT sector has been re-rated higher as a result of that transaction. So basically, it's a testament to what we see as the overall value of the Canadian real estate market. And real estate is basically like any commodity, and it really is reflective of the health of our Canadian market today. So we really continue to be very constructive on real estate in this market. And that's not only in the industrial REITs. Our retail REITs, which are brick and mortar REITs, we think are also well positioned. And in Canada, we're not talking about shopping malls. Our retail REITs in Canada are typically open air, grocery anchored, necessity based retail. And we think they continue to be very well positioned. In essence, it's the shopping malls that are most challenged and effectively trying to compete against e-commerce. But grocery anchored retail, which is what we own in this portfolio, continues to do very well. And the other area that we like would be our apartment REITs. These apartment REITs effectively are operating at 98, 99% occupancy. We have a shortage of housing in Canada. The average housing per capita in this country is below the average of any other G7 country. And in Ontario, which is our largest province, which is where Toronto is located, it's actually below the Canadian average. With all this new immigration that we've got coming into this country every year, it continues to keep upward pressure on housing and basically creates a structural demand for apartment REITs. So this is a sector that we continue to really like in this market. With respect to our energy weighting, as I alluded earlier, we believe we're in the very early stages of an energy transition from traditional fossil fuels to renewable energy. And as a result, we think there's a role in our portfolio for both types of companies. And in our fossil fuels companies, we've got a number of issuers, which I'll highlight in a second, which we think continue to be very well positioned and have been very significant performers in the market and in our portfolio. On the ESG leaders, those are basically the renewable businesses, and these are companies that are in wind and solar, and we've got a number of these companies in our Canadian market. So what you'll see in our portfolio is a balance between the ESG improvers, which are traditionally the fossil fuel companies. We're putting billions of dollars into areas like carbon capture and storage and hydrogen, versus our renewable businesses, which are basically our ESG leaders. Let me just flip through this slide here. and basically talk about some of our energy producers. So these are companies like Canadian Natural Resources, which you can see on this slide, has a market capitalization of about $80 billion and has an annual growth rate in its dividend of about 22% over the last 20 years. So again, this is a company that is subjected to the volatility in commodity prices. And recall, during 2015 to 2020, you basically had a depression in energy markets. This company continued to pay a dividend through that period, as well as a company like Tourmaline Oil, who's the largest natural gas player in Canada. And it effectively has announced 5 consecutive special distributions, i.e. dividends, resulting in an annualized yield of about 8 or 9%. So we think as a result of commodity prices, which will remain in this range of $70 to $80 per barrel, or natural gas prices in the range of $5 to $6 a million cubic feet, we think they're going to continue to generate very high levels of cash flow, which will continue to be paid out to investors in the forms of higher dividends. And these companies, by virtue of generating so much cash flow, are also significantly paying down their debt. A number of them will effectively be debt-free at this time next year, just given how robust their cash flows are. I talked about utilities and renewables. These are companies like Capital Power and Brookfield Renewables, which again are benefiting from massive amounts of new capital, and we think they'll continue to capture market share and continue to grow their businesses, not only in Canada, but also internationally. So there's also room for these types of businesses in our portfolio. Just a couple of comments on our Canadian banks. We have 6 large banks in this country, and those banks continue to be among the best capitalized of any banking sector globally. And as you can see on the table at the bottom, when you look back to the most recent crises in the economy, whether it was the global financial crisis of 2008, 2009, or the pandemic of 2020, our Canadian banks never reduced their dividends, whereas we saw U.S. banks suspend or eliminate dividends altogether during the global financial crisis. And what we saw in the UK is basically every bank having to eliminate its dividend. That didn't happen in Canada. And in fact, our 6 banks are reporting earnings over the next couple of weeks. We're expecting an additional 7 to 8% dividend bump as a result. So these are very solid businesses that are diversified across wealth management, capital markets, and now finally starting to see their loan books contribute to earnings by virtue of this move up in interest rates. As you can see on this slide, the yields on our banks continues to be quite substantial. We own all 6 banks in this portfolio, and you can see how significant the dividend increases have been over time as well. So this will continue to be a very significant part of our portfolio, given how well positioned and attractively valued our banks are in the Canadian market currently. They trade at about a 9.5 times price earnings multiple versus their historical range of 10 to 12 times. So not only are we getting great dividends out of these businesses and dividend increases out of these banks, they're also attractively valued. Last but certainly not least is our focus on dividends. Every company in our portfolio is paying a dividend. And as you can see from this slide, since June 30 of last year, over 80% of our portfolio companies have increased their dividends. And that's the reason why we continue to be confident about our ability to pay out our 5.1p distribution of this fund, which, as I say, is fully covered in the 2022 calendar year. So again, our focus being on income while continuing to identify businesses that are growing their distribution over time, their dividend over time, and generating capital growth. So just to summarize here, this is a very unique portfolio. There's nothing like it in the UK market right now, where you're getting exposure to Canada with significant exposure to income as well, and growing income in the portfolio. And as Hugo mentioned off the top, it continues to be attractively valued, trading at about a 15% discount to NAV, with what we believe is a very positive outlook for the Canadian market generally. So with that, Hugo, I'll pass it back to you.
Brilliant, Dean. That was great, and a very comprehensive overview of both the trust and Canada itself. I've got quite a few questions coming through, actually, a few more macro top level and a few more specific to the fund and the dividend. I'll probably start with the macro stuff first. It's very topical over in this country at the moment, and I've got an investor wondering whether the Canadian government is considering windfall taxes on oil and gas companies.
Yeah, great question. And our Canadian oil and gas companies, they're certainly generating high levels of cash flow, but they've been highly taxed for some time. So they basically drill, for the most part, on Crown lands. And whether it's a provincial government or the federal government, they're collecting very significant levels of royalties already. As a result of how highly taxed they are and have been, we haven't heard any rumblings, fortunately, out of the federal or provincial governments in terms of increasing taxes. And I think the other point that's worthy of mentioning is that the world effectively changed on February 24th this year when Russia invaded Ukraine. And I think Canada has really come to appreciate the advantage it has as a secure and significant source of both natural gas and oil. And we're starting to finally hear some overtures from our governments that they're going to try to help increase the production here because they realize places like the UK and Europe need more gas from a secure and reliable source like Canada, where the rule of law governs. So fortunately, we're starting to get some encouraging news out of government as opposed to seeing things like windfall taxes.
Brilliant. That's very helpful, Dean. Just on to the US very quickly, clearly very topical with the midterms going on, looking like they'll be relatively close. Just wondering if there are any positive or negative implications, for Canada with either result.
Well, the first thing I'd say is that here's another example, just like you all saw with Brexit, that the pollsters often get this wrong. Everyone was expecting, maybe one of the reasons why the market was up yesterday is a bit of a red wave, i.e. the Republicans really going to significantly increase their position within the lower house, being House of Representatives, as well as the Senate. Now, they have gotten control of the House of Representatives, but at a much slimmer margin than was thought yesterday. And looks like we're going to see some runoffs in the Senate, whereas many people thought they were actually going to get the Senate as well. Bottom line is we are, or the U.S. in particular, is a divided country, and we think this is overall more positive. Markets tend to do well with a divided government, whether that's a Democrat or a Republican in the White House and Congress split or controlled by one of the other parties. And in years where you have had a division of power between the White House and Congress, as it looks like we're going to end up with once those final Senate seat runoffs occur, markets tend to be up somewhere between 10 and 13%. Markets like gridlock because they are often concerned about governments meddling into corporate affairs when they have too much control.
Thanks, Dean. That is some very helpful commentary. Just flipping over to some aspects of the portfolio, you talked a little bit about REITs and property. I've got an investor noting that Canadian house prices have clearly gone up quite significantly over the past few years, or that's what we hear in the news at the very least. Do you see current prices as sustainable going forward?
So it's a great question. And just to give you some data, our housing prices are much higher than where they were pre-COVID, but they're down by about 10% from their peak early this year. And that's really not surprising with the move in interest rates. Having said that, as I outlined earlier, we still have a housing shortage in this market, which, when you compare it to other G7 countries, our housing per capita is actually the lowest among the G7. We've got significant levels of immigration, and home ownership is effectively out of reach for most immigrants when they come into this country. And the average is 5 to 7 years of renting before you can afford to buy a home for most immigrants. So We think that's going to result in structural support for housing markets. At the end of the day, this is really a supply issue. We have this structural demand, but we have a shortage of housing, and governments have to work together with industry to figure out ways to increase the supply. So bottom line is, and I've been fielding this question from international investors for the better part of the last 20 years. We think housing prices will remain relatively high. That's not to say that you won't see some volatility or some additional pullback, but we don't think it's going to be significant as a result of that supply-demand imbalance that we've been seeing and will likely to see for years to come.
Thank you, Dean. That's very helpful indeed. Another area of the portfolio to quickly discuss. Obviously, banks and financials, a big part of the Canadian market and a big exposure for you guys. We know them all very well over here in the UK, and I've just got an investor wondering, why does the Canadian sort of banking system seem to punch so far above its weight relative to others?
So I think one of the main reasons for that is that we really only have 6 banks in this country. It effectively operates like an oligopoly, which basically means there's not a lot of competition in this market. So what might not be great for consumers is actually great for the banking sector. So think back to 2008, 2009. At that point in the US, you had over 10,000 banks competing very aggressively on the housing market and developing some very esoteric and exotic derivative instruments to get exposure to this housing market. We really didn't have that in the Canadian market. So as a result, our banks always operated more conservatively because they didn't have to reach for earnings because they were effectively competing very closely and aligning themselves in terms of how they moved interest rates on mortgages. There is really very little competition here on that front. And we've also got a regulator here who continues to push for more conservatism versus taking more risks. So our capital ratios among our Canadian banks range between 13 and 15% today. The average US capital ratios, i.e. that is the buffer below the amount of debt on your balance sheet, is somewhere between 9 and 11%. So our banks are effectively more conservatively run, and as a result, that creates greater stability in their ability to handle various economic cycles. So as I say, we're happy owners of the banks because they are a great hedge against some of the volatility that we're seeing in the market, not only among broader equities, but even among financial sectors in other countries.
Great, Dean. That's some really helpful colour. And just on the topic of Canadian banks, I've just got an investor wondering, given the extrapolation of technology in Canada and it becoming such a hub, are you expecting to see any disruption from fintech when it comes to Canadian banks?
So we're already starting to see some of that. So our Canadian banks, by virtue of having such significant levels of cash flow, have been making major investments in fintech, and they continue to diversify their businesses because they've got such robust amounts of cash. We've seen Canadian banks going into, say, the UK market, and we've seen RBC just announce over the past several months the acquisition of Brewin Dolphin, which is a major wealth manager in the UK market. We're seeing Bank of Montreal go in to the US market and is in the middle of a $20 billion acquisition buying Bank of the West. We're seeing the TD Bank go into the US market, completing a $14 billion acquisition of First Horizons. The TD Bank today is the 6th largest bank in the US. So all of these acquisitions are in an effort to create greater stability and diversification, as well as gain access to various types of advances in fintech. So our Canadian banks are well aware of the risks that fintech offers and are taking measures to ensure that they're well protected.
Thanks, Dean. That makes a lot of sense. So I've had a few more questions come in that I think are very relevant. Just jumping back to real estate, if you don't mind, Dean. Obviously, given interest rate moving north, are you seeing more potential downside to residential prices? Any color on that would be very helpful.
So, as I said, we've seen our real estate prices in Canada pull back by about 10%. This is on average from their peak earlier this year. And I think the fact that we're nearing the end of our interest rate increases, I think most of that pain has already been felt in terms of housing prices. On more commercially oriented real estate, though, I do think there's going to be some additional potential reduction in net asset values on commercial real estate by virtue of rates going up. However, that's going to be offset to a certain extent by the increase in the revenues of these commercial real estate businesses. And the best example here is industrial real estate. So when you value a piece of industrial real estate, part of the equation includes increasing the interest rate to discount your cash flows. And because rates have been going up over the course of 2022, the interest rate you use should be going up. However, your revenue is also going up. In industrial real estate today, Canada-wide, rents are basically up by about 30% year over year. That's how tight this market is. In places like Toronto, the vacancy rate for industrial real estate is less than 1%. And these are the types of issues that the Singapore-based sovereign wealth fund saw when they announced the acquisition of Summit. They're seeing substantial and structural increases in revenue. Even though rates are going higher, it's being more than offset by the increases in revenue, i.e. rents in these businesses. So overall, we think they continue to be in good shape, even with the rises in rates.
Thank you, Dean. That's a very comprehensive answer. Again, just jumping to one final macro question, and then very cognizant of time, so I'll move on to a couple of, in fact, one dividend-related question at the end. Time to get crystal ball out, I think. But do you have any outlook for oil and gas prices going forward?
So, if anything, the pressure is to the upside on oil and gas prices. And that's for a few reasons. Number one, it's very difficult to predict how the situation in Ukraine will be resolved or when it gets resolved. So I think that uncertainty effectively supports prices higher. And I think the other factor is that the Nord Stream pipeline, we know it was damaged, and it's going to take a long time for that gas to come back on. So while things, I think, look okay in Europe in the short term because reserves have been filled because we've had the benefit of that Nord Stream pipeline gas coming in for the better part of 2022. I think the challenge is what it's going to look like this time next year if, in fact, we don't get the Nord Stream pipeline back on, whether that's because it hasn't been repaired or the situation with Russia is no better than it is today. So that's an issue. The other factor, which I think is just as important, is China. We know the Chinese government has adopted this zero COVID policy, and we're seeing many major manufacturing effectively being shut down, and lots of stories about that. And you saw Apple earlier this week saying some of its major suppliers in China cannot produce the amount of smartphones that they were anticipating because of the COVID protocols. So at some point here, Chinese demand will start picking up. Let's assume that over the next 6 or 9 months, they start getting their COVID situation under control. They eventually start reopening their economy. The incremental demand for oil and gas coming out of China will be significant. And given how tight the market is today, we think that puts upward pressure on prices. I think the other factor outside of demand is really on the supply side. What's happened over the last 5 or 7 years is that energy companies, particularly in North America, have come to appreciate that drilling for more oil and gas does not necessarily generate better returns. And as I mentioned earlier, they're starting to prioritize returns by way of increases in dividends or share buybacks to investors. And as a result, we think that also represents a constraint on new supply, together with potential increases in demand, I think supports prices higher. So oil prices today at $80 or $90 a barrel, we think are quite reasonable, and gas prices in North America at $5 or $6, we think are also quite reasonable. I think the important thing to appreciate as far as an equity investor goes is that our Canadian energy names are discounting prices, i.e. reflecting oil or gas prices that are well below the prices that are in the market. So even if prices do pull back, which we think is possible but not as likely, our Canadian companies continue to be very well positioned.
Thank you very much, Dean. That was really comprehensive as well. So just very cognizant of time, as I said. So we'll end on this question in relation to the dividend and the underlying yield of the portfolio. Clearly, you showed that dividends are on the rise, broadly speaking, across the portfolio. Your dividends obviously been very, very consistent over many years now, which is great for investors. But I've got one investor just wondering what the prospects are for the board potentially raising the dividend in the short to medium term.
It is certainly something that the board has been considering, just in light of the substantial dividend coverage in the portfolio in 2022. The board is going to be meeting over the next few weeks, and I think it's going to be weighing, the prospect of increasing the dividend against, what are the risks in the market, what's happening to the exchange rate, because the fund is unhedged at this point as far as the exchange rate between Canada and the pound. And it also will consider whether some of these increases in dividend income should be going into reserves. So I think it's going to be considering all of those factors when it determines what's the right level of dividends to be paying to investors. But clearly, it is something that is at the top of their priority list.
Brilliant, Dean. I know always a difficult question to answer, so thank you for that colour. I think we'll call it a day there. So from my side, thank you to Dean for the presentation. Hopefully a really instructive update for investors, and importantly, thank you to all the investors that joined today. I think that's it from me, so I'll wish everyone a good afternoon. And Dean, thank you again for your time.
Thank you. Appreciate it. Have a great day.
Bye-bye.